We have the process, we have the portfolio, we have the strategy to navigate through this. That's what we want our portfolio to be, is a little bit more of a all-terrain type of vehicle that's going to navigate through conditions regardless of what's going on out there. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, here we go. We're back. It's Friday. It's the long weekend. We got some nice weather outside. Markets have been all right. A little mixed, but they're all right. How you doing over there, Greg? What's going on? What's happening for the long weekend?
Yeah, we got the long weekend, the unofficial start to summer. I've kind of transitioned to my summer work clothes here. The weather's supposed to be good, so all good news heading into the long weekend. No complaints. What about you? Are you heading up north or?
Yeah, we are. We haven't been in quite a while with all the sports and activities, but we're heading up there. I think we'll be up there more over the weekends through the season, but all the sports, all the activities haven't allowed that, but they've transitioned now to weekdays. So we got soccer and lacrosse and baseball going on now. So we got new stuff happening for everybody. But the weekend is relatively free.
So Connor's hockey, is that officially finished? Because I know it ended, but then we moved to tryouts. So is that done?
Yeah, there's some camps. He's doing some camps in that here and there, but no, it's done. It's done until next season. So can maybe hear about some other stuff, other stuff in the meantime. How about you? Are you heading up north?
So we are, and I got a little piece of good news actually. Usually the May long weekend, it's we're going up north, we're doing docks, we're kind of opening up the cottage, but I got a call from my dad that he actually already did the docks. He hired someone this year, which is a first. So we're not doing docks this weekend. So we're just able to enjoy the nice weather. So it should be good.
There you go. That's awesome. That'll be fun. So yeah, looking forward to getting into it, diving into things today. We're gonna talk a little bit more sort of markets and big picture, just because that's a lot of the questions that we've been getting from clients. The last couple of weeks we talked about financial planning and tax and things on that end, but we want to go back to markets because a lot of clients are kind of asking, well, what's going on here? Unbelievable how resilient the markets have been. I mean, they have been a little bit choppier, softer this week. We have over the last while been in a relatively more defensive position, just where we're holding more defensive assets, higher levels of cash, which has served us well overall for the most part, but kind of wanted to talk big picture, talk about some of these themes and sort of what's going on and some of the longer term patterns and cycles that we're seeing happening. But yeah, looking forward to diving into things here.
Well, just on your point about the resiliency of the market. So you think about the last 6 weeks or so, you have inflation coming in, maybe running a little warmer. You got kind of still that geopolitical tension, but markets are still at all-time highs, obviously a little softer today, but the markets have been really robust, really resilient. And a lot of that has to do with what we've seen with semiconductors, chips, technology, all together. So I guess as a starting point, maybe just give us some perspective on what we're seeing on that area overall.
Yeah, I mean, it's still, look, there's volatility for sure, but the AI trade is still very much intact. What you have seen in the technology, which has been one of the big leaders of the market, is the software area of the market has gotten beat up pretty significantly, and it's seen as AI coming in and just eliminating the need for software and all the engineers and everything that's involved in there. And the hardware space is what's really taken off. And that's where our much more direct exposure in technology is in all the hard assets and the infrastructure and the chips and everything that's involved in that. So I think, look at this big picture. I think that's what is driving this growth largely. I mean, not entirely, but I'm sort of seeing two parallel themes. And one kind of reminds me of the 90s a little bit, which we've talked about. The other maybe reminds me of the environment in the 2000s, which is what we're seeing with commodities and materials and energy and natural resources. And they're both they're related, they're running in parallel. But I think when you look big picture, there's one market on one hand that is this tech boom that's been this 10, 15-year long-term secular bull market that's been going on and continues to move along and move in the right direction. But on the other hand, you have this commodities market, which we've seen gold be kind of the first tip of the spear. We've also now seen it with oil and a lot of the other areas and base metals and other energy, that there's massive demand for these commodities, undersupply. And I think we're in the early stages of what's likely to be a longer term cycle of super cycle for the commodities. So it reminds me a bit of the 1990s, 2000 historical market perspective, but that's a little bit what we want to talk about, is those big picture patterns and cycles, and maybe a transition that we'll see at some point in the market from less of the growth and more to the value in other pockets of the market.
Well, what's interesting, kind of using your analogy, the 90s and the 2000s, you kind of had the tech, but then you also had the commodities. But now you kind of have tech and AI and commodities kind of working together in tandem. But I guess just as it relates to kind of that the tech space in the 90s, like what are some of the parallels that you're seeing that kind of remind you of that time?
I mean, look, it's explosive growth in technology. Think of it. You have this new, innovative, incredibly disruptive technology when you compare it to the internet that, yes, is world changing, game changing. There's a ton of money flowing into it. I think that's the obvious one. It's the whole technology story and this just disruptive, incredibly innovative technology with AI. But there's a lot of differences. I mean, I do think even with AI. I'm not convinced that this is 1999 and we're on the early 2000s here, and we're on the cusp of this bubble bursting, because although there's pockets that have done incredibly well, like the semiconductors is the example, there's still a healthy degree of skepticism. If you look at areas like the Nasdaq at the peak of that tech bubble, I think the Nasdaq 100 was trading at like 100 times earnings or something like that. And these days, it's nowhere close to that. I mean, yes, there's areas and pockets that have insane valuations, but I mean, I don't think you're at the point where you've got your every single person. I mean, you got there a little while ago with Bitcoin as an example, and you saw what happened with Bitcoin, where every Uber driver and every person that you met everywhere was telling you to buy Bitcoin. I don't think you're quite there with AI stocks. A lot of the companies that are participating in it are a lot more. These are mature, big, established, very well-known businesses. I mean, there's definitely a lot of excitement and there's a lot of steam. I mean, the AI stuff, we were looking at it even just a couple days ago, and it looked like it was probably running a little bit hot and needing to be checked and pulled back. But that's the environment that reminds me is it just historically is like this could very much be like the 90s, not necessarily a new idea that we're bringing here, but maybe it's not 99, but could it be 97, 98, where we're getting to the end of this longer term bull market? But I think the next phase maybe we talk about is what that possibly that transition and what these other areas of the market might look like.
Well, it's interesting because it's almost like you want to straddle playing like offense. We want to participate in this AI boom that's going on, but we also just want to be mindful on kind of some of those longer trends and what's been working. We've talked about it a bunch. It's just been gold. And to your point, that's kind of been the head of the sphere, but we're really kind of seeing this start of a commodity boom overall.
Yeah, and a lot of that is it is very much right now is AI driven, because just so much demand. I mean, not necessarily, certainly not the gold space, but a lot of things like the energy and a lot of the base metals and other areas in that complex are very much driven by gold. But you think of environments. Even going way back, the 70s were a period where higher inflation, much higher commodity prices, lasted through the early 80s, and then you transitioned to a long-term bull market that carried all the way through the 90s until it eventually ended in early 2000s. But the point being with that is that I think if you're positioned the right way, I mean, think of those times in 2000. If you were very heavily invested in Nasdaq, high tech, internet companies, it really wasn't a great time to be invested. But through the 2000s, if you were more value focused, dividend focused, if you were focused on natural resources, commodities, TSX, even just the right areas of the market, some of the emerging markets, other pockets did quite well through that period. So that's what we're potentially starting to see is leadership changing where it's not necessarily just driven by this tech stuff, but there's other areas of the market starting to come in and pick up. And that's how we're looking at portfolios is not necessarily, we're certainly not all in on AI and tech, but I think that's where you see big risk. But we're working to diversify, go to some other areas of the market, go to where what's working to make sure that we're nicely hedged, but participating where the trends and things direction are going.
Well, that's a good example. A few weeks ago or so, like we made some trades, and it was not going into more AI stuff. It was actually going into more commodity stuff that's actually done really well in a relatively short amount of time. So is it a little bit of a balancing act by making sure we're participating to what's happening today, but making sure we're not overexposed and watching some of those longer term trends as well.
Yeah, and I think that's the idea is making sure that we're well diversified and well positioned for where things are headed. I mean, I do think you're just seeing that those movements towards more a lot more hard assets as well. Like we've got some global infrastructure investments and other areas along those lines. Is as environments transition. Certainly looking at more real assets, real earnings, real cash flows, those sorts of things definitely is beneficial. What's sort of interesting with the whole AI and whole chip story as well is that is the hard asset part of that story. That it's more about okay, this is the critical infrastructure, this is the strategic resource that's needed. So you kind of are seeing those themes blend together where one hand, yes, you've got this explosive technology, this insane growth, which is awesome to see, but it's also fueling all these strategic resource investments, all these natural resources, stockpiling of all these commodities, which is a very interesting environment. But that's the theme, some of the themes that we're seeing develop and take place in the market. So it's very, I mean, no two markets are ever the same, but it's a very interesting time when you look at sort of these market drivers where we look like we're at in this cycle and trend and where it looks like we're going.
Does that pose a little bit of an additional challenge? Like kind of using your analogy, going back to the 90s and the 2000s, you kind of had tech was the more offensive piece, commodities were maybe the more defensive piece. But what we've seen now is that tech and commodities are more or less kind of moving in tandem together. Does that pose just more challenges
Yeah,
overall?
I mean, look, that's neither of those. It's not like the all these natural resources. They're not. This is not a low risk area. I don't know if I would call it a defensive area as well. I would just say that the correlation tends to differ a little bit, and they don't necessarily move in lockstep. And so, if you looked at the 2000s were a really good example where that was a great time in that super cycle to be invested in commodities and natural resources and materials and energy. But you look at that through the 2010s and that decade and was pretty brutal. And even through it was really until after COVID that has all started to pick up and be a great place to invest. But that's a great place for the TSX. That's a great place for Canadian investors. In my opinion, the whole Canadian economy, we're a natural resources economy. We need commodities to be going. We need precious metals. We need energy. That's what we have that's unique as a country and is going to drive this market and this economy. So it's really good for Canadian investors, this environment. The US market, in contrast, is very, very tech heavy, very dependent on growth. And not that we don't want to participate in that, and we do. We just want to make sure that we're diversified and in the right parts of that. Software is a good example that if you were too heavily invested in software in this environment in the last while, you really would have taken it on the chin. Whereas hardware and especially the chips and strategic resources feeding into AI, even things like power that's feeding into it. That's the part of this story that you want to be on. So it's just a matter of looking at things, thinking it through, making sure that we're in the right themes, sectors, pockets, areas of the market to make sure that we're well hedged, but also participating in the upside and the growth that's going on.
Yeah, so it's maybe not so much a question, okay, are we fully invested? Are we underweight, overweight, at target? It's more, okay, what actual specific areas are we in and what's actually driving growth and returns?
Yeah, for sure. And I mean, look, we still will, I agree with that, but we still will adjust and shift the asset allocation based on changing conditions. We have been relatively underweight the last little while and just hedging a little bit and keeping some cash reserves as we often do in our portfolios. But that's more about managing risk. And it's also to make sure we've got dry powder to be opportunistic and can be tactical and deploy it when that makes sense. But I think, yes, more so it's okay, are we in those right sectors, subsectors, themes, areas of the market that are moving in the right direction? And what we've seen in the last year and a half, especially since the US election, is things have changed a lot. There's all these nationalization that's happened. There's borders are being reestablished. You have reindustrialization. So there's all sorts of stockpiling of these strategic resources, whether it is commodities or chips or all sorts of things. And countries are seeing their natural resources as being they're not necessarily looking to sell and trade as much with other countries. They're more looking to stockpile those. So there's this massive demand. These things move in long cycles too, where it takes years and years to build a mine and put it together and get it set up. And so it just creates this structural imbalance where there's incredible demand, there's limited supply. That's what you see with the chips as well, but all sorts of other areas, and it's driving growth. I mean, we talked about another area too. Defense is another one when we talk about all this nationalization, just sort of changing world order. I think since the war in Iran, it's come under a little bit of pressure because of a whole host of factors, but that's another area you think strategically there's massive investments going in. We've wanted to participate. We've done quite well in it. So we're working to position portfolios to be aligned with these themes, where the world is headed, looking at trends and just looking to best manage things and govern the portfolio accordingly.
Yeah, absolutely. And just to kind of bring it back to the here and now, obviously it's been a crazy year. You had the big sell off in March, you had the huge recovery. Markets are all near all-time high. There's a lot of headline risk going on right now. What would be your message to investors at this point? Maybe even just more from like a mindset standpoint.
Just stick with the process. I mean, none of this is that out of the ordinary. I mean, we've seen it even in the last five or 10 years. There's all sorts of major market events that will happen. We've had, I mean, March was maybe a little bit more minor in the grand scheme of things, but still a lot of volatility with the war. I mean, we've had 2022, we had COVID, we had the tariff crash of 2025, 2018, all sorts of events that have happened. So this is par for the course that we're going to get these market events. It's just, we have the process, we have the portfolio, we have the strategy to navigate through this. That's what we want our portfolio to be, is a little bit more of a all-terrain type of vehicle that's going to navigate through conditions regardless of what's going on out there. So stick with the process. That's what it's about. We want you to be wealthy. We want to see portfolios moving in the right direction, managing risk, steering through things. We want you to feel wealthy, enjoying life, enjoying retirement, enjoying the long weekend, the warm weather. We want you to realize your wealth. That's what we're all about. That's what Aretec Wealth is all about. So we'll be back with everybody next week, and enjoy the long weekend, everybody.
Good one.